So welcome everyone. Today we have a great discussion talking about the intersection of technology, energy, and finance. So we've brought Matthew Sigel, who's an expert at VanEck, to discuss some of these topics with Stephen. So on that front, Stephen, I'll let you handle the discussion. Thank you for joining us, everyone.
Yeah, just some housekeeping items. I just wanted to make it clear that this is not a solicitation of any kind. It's really for informational purposes only. Thank you for joining us today. I'm super excited about the topic. I'm super excited for all the different variations and where this is going to go, because it's going to be like an open dialogue kind of webinar, which we haven't done in the past. Also, I do want to also specify that VanEck is not affiliated with LPL or affiliated with Stonewater. They're their own entity, but they're good friends of mine, and I really enjoy the research and the partnership. So with that said, I'm Stephen Bernstein. I cater to high net worth and ultra high net worth individuals and small businesses. What I try to do is help them understand their finances, from budgeting to setting up the right types of tax structures to mitigating taxes as best as possible, and also setting the right framework and creating the right buckets for short, middle, and long-term financial goals and objectives. So I like to invest money for those high net worth individuals and help them navigate through the financial challenges. As many of you know, today's environment is quite interesting. This year was expected to be a lot more downside than upside, and it's been, hold on for dear life. It's been actually amazing how the economy has been robust and growing, and in spite of all the different challenges that we see with political environment, with cost of living going up, inflationary pressures, all these different, even like wars, everything, you take it all into the mix, and you see that the market has actually been very resilient. And part of that is definitely the AI theme, but it also incorporates some of blockchain, cryptocurrency. These are just like, we're going to define all of these different variances, but what we would like to do is to start off with is really just give you what they are, how they're relevant today, and then you make your own investment decisions moving forward. So with that, thank you, Matthew Sigel, for joining us today. Super excited to have you on the call. I guess just to get us started, why don't we start off with just doing a definition of what is blockchain, what is cryptocurrency, what is tokenization?
Sure. Good to be with you, Stephen, and everyone. Blockchain is simply open source software. So in this case, open source database software. So if you go back to, really the history of banking is about trust, and you're trusting a bank to maintain the ledger of who owns how many dollars. It's super tempting to lie and cheat when you own the ledger. So those businesses are built over decades and centuries of trust. The mathematics around cryptography, have evolved in the last 50 years. And a few decades ago, there was an innovation in cryptography that solved this double spend problem, really, so that you could engineer a piece of software that's open sourced, where two people can have the same ledger at the same time. And that's really what Bitcoin is. The Bitcoin token is just a representation of that innovation. And then each blockchain and cryptocurrency is basically a wrinkle on that theme. Open source database software. So you can extend that analogy to big tech, where Twitter holds the keys to their algorithm, and you can't see it, and you wonder why your post is not going viral, someone else's is. It's because it's trust. You're trusting them to maintain the database. But with these new innovations around cryptography and the liberalization of cryptography, it used to be illegal to export decent cryptography. Bill Clinton liberalized that, and Bitcoin was, I think, the first killer app in the open source, cryptography applied to database software. So that's my 100,000-foot view.
Love that. It's interesting. There's a movie that I watched, Ready Player One, and it's all about living in a world that doesn't exist, right? And people can be who they want to be and pretend to be who they don't want to be, right? They can like bring into their own some of their. I guess if you're a silent person who doesn't like to be outgoing, you could be more outgoing, etc. But I sort of look at this world as this new innovation, similar to like what the dot-com was back in the 90s, where people didn't understand being online and what that meant. And then you create this universe that exists, and then and people don't like change, and people don't like things that they don't understand. So I love the fact that we're going through this. So what is on-chain? What exactly does on-chain mean? And how does it relay into all of these different platforms and this open, decentralized space?
Yeah, on-chain just means that you're a participant in the usage of this database software, often by owning a token. And instead of entrusting that token, like a Bitcoin, that each one is worth $100,000, normally you might put that in the bank, but you can actually hold it yourself in a crypto wallet. And that's essentially what on-chain means, is holding your own keys to a certain extent to your own assets. And that makes crypto a bearer asset. And the world has been moving away from bearer assets over the last few decades, but considerable demand still exists. And there's a lot of use cases when it's digital. On your movie analogy there, the movie that comes to mind for me more is Idiocracy. Check it out, 2006. Okay,
Yeah.
So and in that movie, right, social media is actually predicted in a way, right, that we would all kind of get burrow into these digital worlds, and they're global, right? So there's a huge scale to them, and crypto probably wouldn't have existed without social media, because social media created demand for this instantaneous meme generation, and memes, can have value. And so it's really like instantaneous capital formation globally without asking your bank for permission. And that's why I think it's been such a phenomenon.
So let's shift to regulation, right? Because when originally I heard of what Bitcoin was, or any cryptocurrency, to me the biggest hindrance, or that wall, was there's no regulation, right? We have black market. All of these sex traffickers and arms dealers are basically utilizing this to siphon money and not pay taxes on it, and be able to do things that are, I say, like, negative, right? So how have we changed in the last decade, where now you're seeing the BlackRocks of the world, the JP Morgans of the world, all these big financial institutions start to enter the space in some way, shape, or form? And I guess, does that tie into like this concept of tokenization? Like, what is tokenization?
Yeah, in my view, most of the AML KYC concerns were just a talking point for banks to try to fight this trend, because it is negative for banks. So a simple Google or ChatGPT search will show you the amount of banking infractions on AML KYC. It's orders of magnitude above crypto, both on a percentage basis and then certainly on a gross basis. The anecdote that comes to mind is that when the US Fed controlled the Iraqi central bank, we ended up sending tens of billions of dollars to Iran, just through someone was in charge of the ledger who, we probably shouldn't have trusted. So that argument to me, one person's money laundering is another person's freedom fighting. And for me, I never really bought that. But the issue of custody, right? Fiduciaries can't hold the client assets. That's rule number one of being a fiduciary. Because over the years, the Bernie Madoffs exist, and for prudence, we've separated those powers. And when you come into a technology like crypto, where you can actually hold your own keys and you participating directly on the blockchain, it's inherently at odds with that custody function. And it took a few years to work that out. And that's really what the ETFs have solved for, is applying the same level of regulation around custody to digital assets as we do to traditional securities.
So let's open up one more level further with that, because it seems like participation is a big deal, right? Like if it's adopted and it's open source, everyone can see it. It also depends on who's behind that open source, who can, like, what kind of people are in charge of that open source to sort of push it a certain way. Does that make sense? I mean, like, the Ready Player One is my example, only because Ready Player One, there was one individual who figured out the tricks, right? And then took everyone else to come on board. And are we seeing that today, where you have this open source, people have to participate in order for it to work. If people don't participate, it won't work and it will fail. And then, obviously, I sort of also look at it as going back to alcohol, where it was not allowed, it was illegal, and then suddenly it was legalized because the demand was so high. So does demand here play a big shift in whether or not it's adopted, and does the demand here have an impact on how regulatory environment matters versus does not matter?
Yeah,
because institutions, we believe in the institutions, right? We believe that the institutions are supposed to be there to have some guardrails. So without guardrails, do we still have that in place?
Yeah, I think it's important as Americans to check our financial privilege sometimes. We're very fortunate to have many options for payments. We have banks that we trust. We have a strong currency. We have pretty low inflation. So things are pretty good here. And when you look at the survey work on the countries that are optimistic on Bitcoin versus more skeptical on Bitcoin, the skeptical countries, and this is a very large sample size survey, the skeptical countries are Japan, Canada, Germany, France, UK. What are those countries all like? Pretty much, they're full of old people. They have bad demographics, low inflation, reasonably functioning financial systems, reasonably high trust. So they don't really need Bitcoin. The countries who are most optimistic about Bitcoin: Nigeria, India, Vietnam, South Africa, Argentina. So generally young countries, or countries with high inflation, for less trustworthy institutions, dysfunctional financial systems. So, and by the way, those countries are actually taking market share of global GDP. So you mentioned video. Did you mention video games? No, alcohol, right? So I think of video games analogy that the demographic story for video games was so powerful. 40 years ago, when we were kids, there were no adults playing video games. Now Elon Musk is on social media playing video games. Like, you don't quit, you kind of keep going. But the old people who didn't play, die, and then it's an enormous demographic tailwind. We have a video game ETF that's outperformed the S&P over 5 years. That's, you can't do that without some serious demographic tailwinds, and crypto has that from these the growth in population in developing markets that tend to have higher inflation, weaker currencies. They want something with a global brand like Bitcoin, where nobody really is in control of it. And you made a point about, oh, how do we know really how decentralized these networks are? That's a very fair critique for a meme coin. where one kind of promoter holds 30 or 40% of the supply. That just doesn't exist for Bitcoin to an order of magnitude more than any other blockchain project. And then you have this long tail of projects where it does start to matter. So yeah, it's not really for us. A lot of this crypto, us meaning Americans in the financial system.
Interesting. So what is tokenization? Like, what is the actual definition of tokenization?
Tokenization is creating a digital representation of something which lives in this open source database software. So
And that's what the financial institutions are now.
Yeah. So like Bitcoin, the Bitcoin is the digital representation of your share of ownership of the Bitcoin network. But for a company like Circle, which issues a stable coin called USDC, that USDC token is a digital representation of the dollar that Circle holds in a bank account on your behalf, but you're choosing to hold it on this ledger, this open source ledger, often Ethereum, sometimes others. And that's your blockchain, participation, I would say.
Interesting. So we sort of discussed the banking system disruption and how it's impacting the entire market. Where do you think we're going with adoption in the banking system? One of the things that I sort of came to, somebody mentioned it before, was the ability to know what interest rates are around the world. And let's say you're looking for a loan of a specific type, you can actually see in real time what that cost would be. And being able to understand that and being able to lock in those lower rates because it's an open source could be huge. But that could disrupt the banking system significantly and lose market share in what they do, right? So I'm just curious what your thoughts are on that. And it's I'll sort of throw this in there, which only because it's so timely. They just brought up the 50-year mortgage. I don't know if you saw that. There was something that came up where you can now potentially they're trying to adopt it where you'd have a 50-year mortgage. So does having a mortgage for that long of a period of time may help younger individuals who are just getting started and be able to make those payments, but obviously you're paying a lot more over a longer period of time. So do you see any connection between that and the banking system and where we're headed with the crypto market?
Sure, yeah. So I think that when you talk about crypto impact on the banking system, we need to separate banking system into deposit-taking banks and then the intermediary function, the investment banks. So when it comes to deposit-taking banks, stablecoin, they fought the stablecoin bill, right? Because stablecoins are kind of like a narrow bank. If you've ever heard of a narrow bank, it's a bank that doesn't make loans. They just take deposits and buy T-bills. And it turns out that when you got an over-indebted financial system, there's actually a lot of demand out there for a narrow bank because there's no maturity mismatch. And you're just getting the pure T-bill yield. But narrow banks are illegal. The courts keep ruling them down because the regulators look at them as a threat to the deposit base of these loan-making banks. So what's going to happen to the money supply if there's deposit flight out of loan-making banks into narrow banks? And that's why there's a lot of political opposition to this. So stablecoin impact on these deposit-taking banks could be considerable if consumer behavior were to change in terms of when you go to Amazon and if you used an Amazon stablecoin and Amazon gets to keep the float or pass a little bit of it back to you as a discount, and then you're suddenly moving your money out of JP Morgan Chase, like there's going to be pushback against that for sure. So on the deposit taking banks, they fought it, and now they're kind of embracing it in an innovator's dilemma type of way. You know, that doesn't usually win, but we'll see. On the investment banking function, just matching buyers and sellers of credit or equity, you know, which I think is your point, like the peer-to-peer aspect of what crypto enables. The positives there is that you reach a global audience. The audience is, you know, digitally native and young, and so like demographically, there's a community, I think. But there's also some adverse selection in the sense that the existing financial system works pretty well for blue chip type enterprises. You know, but so a lot of the credit, you know, origination that you see on chain tends to be riskier and often lower quality. So now that stablecoin, there we have regulatory clarity, and if the Clarity Act passes, although the odds are lower than they were 6 months ago, and we had market structure around some of these other tokens, then you might see what you're describing, which is traditional securities that are trading on chain instead. There's a lot of interesting experiments going on there, but liquidity begets liquidity, and we haven't seen the killer app. But I think some of that is because the regulation is still being formed. A lot of no action letters have been written, but it takes time to build this stuff.
Right. Can you, what is the Clarity Act? I think it'd be helpful for listeners to like know what is involved in that.
Yeah. So the Genius Act was the bill that gave stablecoin issuers regulatory clarity, and we've seen this is the year of the bank charter. There have been 22 bank charters applied for. About a third of those are crypto related, because if you can own the bank and the stablecoin, you're going to be in good shape. The Clarity Act is the market structure bill, which is going to give the rules of the road around really what is a security in the context of digital asset. And I saw news on the tape yesterday that SEC is working on a taxonomy for the crypto space, which is something we've been working on for 5 years, and a lot of other folks as well. But that'll be critical to determining which of these projects are truly decentralized and can really be that kind of open source Rails alternative.
Yeah, that's great. So what are some applications you're excited about regarding like stablecoins?
Right now, it's mostly a B2B phenomenon. If you're a crypto exchange, but even just a large market maker or online broker, and you're moving assets across geographies, often to settle internal balances. Typically, you're relying on the banking sector for that, and they're not open on weekends, and they have fees and a number of other frictions that can be ameliorated with stablecoins. So it's a B2B phenomenon right now. That stablecoins will transact about the same amount as the Visa network this year, about 12 trillion US. But the average ticket size is 50 times larger. So for Visa, average ticket size $40. For stablecoins, $2,000. So it's mostly institutions that are moving their money, at their own time rather than at the time that the banks want, and possibly picking up a few extra bips of yield if they deploy those assets into some of these tokenized T-bill funds that are now starting as well. So I think if you've ever tried to take your money out of a Vanguard, for example, you have to fax them a form. You can call and they'll be like, "What are you talking about?" And then a few weeks later, your assets move. It's pretty stressful. So like Interactive Brokers, what they're kind of hinting at, and Robinhood, is they're going to make that easier. And that's a tough decision to make, because you're making it easier for customers to take assets off your platform. but you're also delighting the customer, and it's probably more likely that they'll return, in the future. So that, I think, is going to be one of the major B2B applications, and it would kind of be.
When you mention B2B, like what specific sectors? Like every business? I mean, like what would you consider like the most utilized?
Financial institutions. Those are the ones who are moving their balance sheets around the world most. So I think that's where it starts. Over time, outside of the US, there's a number of e-commerce platforms like Mercado Libre in Brazil and much of Latin America, who's really incentivizing their merchants to use their stablecoin. Same thing is happening with Shopify. So they're a Canadian company, but they enable millions of merchants around the world, and they're actively embracing these stablecoin rails as well. A lot of times you can save on the interchange and a lot of the other fees that kind of get paid along the way. It does involve a change in consumer behavior. So that's where I think the jury is still out on that. But you can imagine a world if there's a clearinghouse for all of these different stablecoins. Right now, it's the market is somewhat consolidated in that Tether and Circle have 70–80% of it. But there's so many new entrants as well that we think there'll probably be a role for a clearinghouse type of business or co-op, and we've been investing there on the private side because then Amazon. Walmart can issue a stable coin and they can give you almost a 3% discount for using it, just because if they're going to avoid all those interchange fees and a deflationary impact that good for consumer welfare. Doesn't necessarily make anyone particularly more money. I mean, maybe Walmart a little, maybe the consumer a little, maybe Circle, if they can really form a moat around USDC for the more regulated countries. Maybe Ethereum, if folks are going to send these dollars globally. But a lot of these technologies, there's more losers than winners. So that's how I think about this space as well.
You mentioned Tether. Tether is one of the largest holders of Treasury, the U.S. Treasury today, right? And I learned a new name, I guess, DATs, digital asset treasuries. Are those one and the same, or they're not? And how does the treasury market, how does the ability for a Tether, for example, to own treasury and have it backed by treasury matter? Like, how does that impact our economy?
Right. So a stablecoin being a digital representation of a dollar, the stablecoin issuer can either put their money in a bank, so literally just hold cash, or they can try to earn some seigniorage, some yield. It's obviously very, very tempting to go for yield. So in its early days, Tether really reached for yield, and they had things like Chinese property debt and all kinds of things backing this. They have considerably de-risked that portfolio in recent years, and it's now essentially all cash and T-bills. Same with USDC. So they have to buy T-bills, and with $300 billion of stablecoins outstanding, stablecoin issuers are starting to become meaningful buyers of the short end of the U.S. Yield curve. So that's why the Secretary Besson often points to stablecoins as having a positive impact on the dollar, similar to the euro-dollar market 50 years ago. So that is how stablecoins and T-bills interact. The DAT, digital asset treasury company phenomenon, that's a separate phenomenon where public companies buy cryptocurrencies and hold it on their balance sheet, and then use financial engineering to apply leverage. So MicroStrategy would be the most famous example of that. And the reason why that took off this summer is a result of the election and the change in attitude that global investment banks have had towards underwriting IPOs, secondaries, SPACs, pipes, all the traditional TradFi stuff. Those pipes opened up, and instead of going into cryptocurrency tokens this year, they kind of went via the corporates, and the listed companies were the biggest buyers of Bitcoin and Ethereum over the last 2 quarters.
What are your thoughts on the whole idea between of DATs and with every new technology, with every new innovation, there's always users and abusers, right? So do you think that there is an abuse part to what they're doing, where they're literally issuing debt and they're securitizing it by Bitcoin or Ethereum or any of these currencies?
I don't think it's abuse. I mean, we all have the right not to buy these things. So, we live in a disclosure-based world, and you might not like what the companies are disclosing, so then don't buy it. But
does it create a bubble? Does it create a bigger problem later on that could completely, erupt?
I mean, most of these stocks are already down like 70-80% from their peaks. So the retail buyer, they were speculating, and we were not. We've been really underweight this part of the market. I do think that some number of these are going to survive and kind of become the Bitcoin banks of the future. That's a very low multiple business. If you think of what that market pays for the pre-tax operating profit of that type of business, it's very low single digits with high risk of negative tail risks. So I think it's about the valuation, and some of them are actually starting to look a little interesting when they trade well below the NAV and have a credible plan to close that, which you can basically do by selling the tokens. So there's always been a reflexive part of this market, and I'm kind of happy to see that the excess came through dilution rather than debt. Because dilution, it's not good, but it's kind of slow bleed down, but it doesn't really cause a cascade.
I love that. That's great. So can you describe DeFi and Ethereum and why is that different than what Bitcoin really represents?
Yeah. So it's all database software, but the Bitcoin database is unique in that it's not programmable. So that's known as being it's not Turing complete, like Alan Turing, the mathematician. So you can basically only just hold Bitcoin or send it or receive it. With Ethereum, it's a more complex system and it's programmable. So you can plug in a lot of if-then type scenarios into the blockchain and make your money move in more complex ways. So it's more appropriate for hosting a trading venue, a peer-to-peer trading venue, where everyone knows the rules of the collateral. And if you're not waiting on a broker phone call, you're just auto liquidated, and there's downsides and positives to that. But essentially, that's what DeFi is peer-to-peer trading using an algorithm that was codified. And Ethereum is one of a handful of flavors of open source database software. So otherwise known as a smart contract platform, because the software that you build is a smart contract. That's what enables this if-then scenario. And then Ethereum is the database that hosts it. Yes.
So what problem does DeFi aim to solve today? Like in today's financial landscape, like what is it trying to solve?
Well, you can reach a global market because no one needs permission to join it. So you don't have to open an account at a financial institution. So global market, peer-to-peer.
Decentralization.
No one can kick you off Bitcoin. Sometimes the spreads can be lower. meaning like there's no, you can capital raise without paying an investment bank 8% of your proceeds, right?
Right.
So when you're launching your meme coin, for example, so there is a cost savings. It's a deflationary technology that requires fewer humans. And that's where I could get back to why social media really turbocharged this is because of that kind of instant social global community thing.
Yeah. So going into AI and Reddit and social, it's funny because I saw that 45% of the data that's been collected on ChatGPT comes from Reddit, or 40%, something pretty high, which I thought was very interesting. So it's coming from feeds that are individualized, right? I don't know where those end up coming from. That's the good question. But how does AI factor into all of this? Like, what are your thoughts on? I mean, we're in a fascinating, new and inventive. Everything's fast paced, where there's a big difference between computing, artificial intelligence, and actually like machine learning, right? Machine learning is learning and being able to like analyze, while AI and more artificial intelligence is more about like bringing everything together faster, from my understanding. So how does that impact this space?
Yeah, I think two main ways that AI and crypto are intersecting, and one is in the digital world, one's in the physical world. So in the digital world, well, have you ever bought an expensive bottle of wine, or the number one thing you need to know
You're invited,
is,
my friend. You're invited.
is it real, right? Like that's the number one thing is it real? How do you know that label is real? And there's been a lot of money lost and people gone to jail over, same with art, right? Is like the provenance of that particular item. And you have to trust someone that it's legit. So if you think about like deep fakes or, that would be like anything that is a disputable piece of news, for example, you're trusting. How do you know who you're trusting that information is accurate? And you're either the idea of having that be decentralized, so anyone can kind of audit where something has been in a digitally native way. That has appeal for a lot of people. We don't exactly have the killer app for it yet, but we're working hard in our venture portfolios on that, and I think you'll see some promising outcomes where crypto helps turbocharge AI by making the data more reliable, so people can actually audit the history of it. So that's the digital impact. The physical impact is really around the energy markets and Bitcoin. So Bitcoin requires a lot of electricity to mine, and it's actually a very high percentage of the bill of materials. So those folks have been super sensitive to electricity prices, and they basically have a lot of very attractive electricity assets around the world. And the value of running GPUs with that power instead of running Bitcoin is a very large arbitrage that many of the Bitcoin miners have been exploiting over the last year and a half. So that creates a high correlation in the markets, I think, because those names who are the incremental provider of gigawatts to the grid, Bitcoin miners, they need debt to build out these fancy data centers. Bitcoin mining data centers are pretty simple. So there is a CapEx to go into repurposing this stuff. And that's going to be, it's been equity issuance and debt. Now the debt issuance that is going to fund those huge CapEx. So Bitcoin is their cash cow to kind of get the loan for companies that previously couldn't even access the capital markets. So when Bitcoin's going down, and if the credit markets are tightening at the same time that Bitcoin is going down, that's a double whammy on some of these names. And that's what you're seeing in the markets the last 4 or 5 days and today. is the companies, the Bitcoin miners who were pivoting are the ones getting hit the hardest in the market.
So I love that segue because energy, I think, is so important, and the need to be able to power these resources, right? So do you think that energy is going to create a slowdown in how fast we can move forward because we don't have enough to consume in the same pace that we're going with the digital currency environment, with Ethereum, with like AI? Do you think that there may be a blockage because the energy is just not, we don't have enough, with too much consumption, we don't have enough to basically provide the resources?
Yeah, I mean, if you believe that thesis, you should buy the fund that I'm managing, VanEck On-Chain Economy ETF. Ticker is NODE, NODE, and that is our entire thesis, which we published a year and a half ago, which is that Bitcoin miners are going to intersect with AI, in a way that's going to transform the energy and electricity markets and also some of those businesses. So I mean, all the big tech CEOs are on podcasts saying that the bottleneck is in power. The bottleneck is in power. We've underinvested in that type of infrastructure over several decades. And it's interesting, the places where power prices are going up the fastest are not where they're building the data centers. They're in California and Hawaii and places that aren't building any data centers because there's just been an underinvestment for so many reasons, right? Part of it is the climate mania that we kind of had a collective fever over that's now breaking, I think, and people are realizing that these atoms are actually incredibly crucial. So the double shock of deglobalization and AI, that's what's hitting this grid, which has been underinvested in for 3 decades. Power demand was basically flat. Now it's inflecting. I think that's a durable theme. I think right now, here on November 13th, with that theme having really outperformed this year, a lot of folks are taking profits, and the credit markets are digesting what is a really considerable issuance, but from companies who can afford it. So we'll see, how it plays out. I think this part of the market's still going to be higher in a year, but this is definitely the testing ground for strategies like the one I just described, which is it includes Bitcoin, includes some data center infrastructure, tokenization, but also as an attempt at a barbell, some of the kind of midstream, downstream energy and electricity value chain, which I think may go through a period of EPS upgrades as we pay for this stuff.
Interesting. So mortgage-backed securities, right? And that was the whole crisis that caused 2008 and the financial crisis. And there's different tranches and levels of better credit and lower credit. So not to mention any names, but I'm just curious, how do you figure out the different tranches between these different options, right? So like, how do you identify, like, what are your valuations? What are your fundamental analysis to basically understand what's your large cap, what's your mid-size, what's your small, where they fall in, where things may go to zero versus like actually being sustainable and go on?
You mean when you're investing in tokens?
Investing in tokens.
Well, with tokens, you have to have the base understanding that 99% of them are not going to be worth anything, and that this is most digital businesses are winner take all or winner take most. So I don't think it's about investing in the long tail. It's kind of going in with a very skeptical view on what the future is going to bring. So our active products have dramatically outperformed our passive products in this space, with the exception of Bitcoin ETF. For that reason, is that there's the winners tend to win here. Now, I mean, in the case of mortgage-backed securities, I'm definitely not the person to talk to about that. But
it was just
you reminded me.
Yeah.
You reminded me of something, which is like First Brands and some of the private lending issues that have popped up in the markets, right, in recent weeks, like what Jamie Dimon called cockroaches, tricolor, and those things, right?
Yeah.
That was a result of double pledging, right? So that's something which tokenization can solve. If the ledger had been an open source blockchain, then they wouldn't have been able to double pledge those assets. And there's actually one public company which IPO'd in the summer called Figure, and they have originated $15 billion of HELOCs on an open source blockchain that they developed themselves. And all of the counterparties and ecosystem is also using that open source blockchain. And as a result, the auditor requires less information, less paperwork. It's a cheaper process for Figure to originate those loans, and they're taking 10% of the incremental HELOC business. That's a name that we liked at the IPO. It was really out of consensus, and I think the market is understanding that they have a cost advantage when it comes to using the blockchain in this way, and it's going to enable them to broaden out into other markets. And it's reasonably priced. So
interesting. I mean, today people can lend out their Bitcoin, right? They can lend out their coins and get an interest for it. So how do you know that that's not being leveraged and lent out multiple times? There's really no regulatory environment to know that coin is not being leveraged multiple times, right?
Depends on the platform. Sometimes you can see a little bit, and you can see what the assets of the lending pool are versus the liability. So there is some transparency, but there's also a lot more temptation to, make mistakes or do something naughty. So we don't really participate in that market. Debt and Bitcoin don't go too well together. We've seen that over the cycles. But I mean, think about a company like MicroStrategy. They have packaged the volatility of Bitcoin into half a dozen fixed income instruments with billions of dollars outstanding. And there is a regulatory wrapper. It's called the U.S. Bankruptcy Code. And so, I would say it's working. And the financialization of Bitcoin, whether you're measuring it as the futures market, the options market, the growth of regulated leverage like MicroStrategy, like it's growing because Bitcoin is taking market share as money.
Love that. That's great. So let's segue into hard assets. Right now the administration, there's a push to bring over rare metals and being able to take market share away from China for different minerals and rare earths, not rare metals, rare earths, etc. Do you think gold, for example, right? Gold, banks used to need to have a certain amount of gold in their vaults in order to lend out. And now we've been printing money like Monopoly, where we just keep on mortgaging and just more and more issuance and taking the dollar down, right? making it devaluing the dollar. So how do you think metals moving forward are going to be? Do you think that these coins will suddenly play a role in being the replacement for gold? Gold 2.0 is a lot of what I've seen on different areas like Reddit, social platforms. But I'm just curious what your thought is on how those hard assets, will they be replaced? Will they not be replaced? How digital assets really can interact with that, whether or not they're going to be intangent or maybe a help rather than just like a replacement, and where we're moving forward with that.
Yeah, I mean, we think there's a tailwind for scarce assets, and that both Bitcoin and gold are a play on the government devaluing your money through irresponsible fiscal and monetary policies that have been ongoing, that are structural, and that much of the world is starting to realize, and the institutions are changing their behaviors. Central banks, acquiring gold, and actually this morning, the first central bank in the world bought Bitcoin. It's actually huge news. Czech Republic, about a year ago, they announced a plan to study the issue. And this is their test portfolio, so $1 million of Bitcoin, and they'll announce the results in 2 or 3 years. But you just have to think about who's gaining market share of global GDP. It's not those countries on the right, on the that I mentioned that are pessimistic on Bitcoin, right? Japan, UK, France, Germany, Italy.
Right.
These are not the countries that are taking share. And there's a lot of data supporting the fact that their currencies, euro, yen, pound, are going to lose market share. So what's going to take market share? It's either, the Indian rupiah, the Chinese RMB, Pakistani, but for the US perspective, President Trump at least, Bitcoin being neutral is better than those other currencies. And a lot of the world agrees with that. So that's how we see both Bitcoin and gold. We run the world's largest gold mining fund. So, we were in a fortunate position to be able to kind of deploy some of those profits into a technology, Bitcoin and digital assets that may take some market share from gold and other kind of historically scarce stores of value, but they both can win. This year was actually gold's turn, unless we have some change in the markets here in the next 6 weeks.
So I'm going to ask you a tough question. What do you expect how do you think this is going to evolve in the next, if you could forecast the next 10 years, right? Where do you think we're going to be? How is adoption going to be? Where do you think the biggest opportunities lie? And where do you think are the areas of potential concern?
I think that this Czech Republic news is just the beginning, that there's now 12 countries around the world that are mining Bitcoin at the central government level in order to monetize some of their stranded energy and earn, a currency that is liquid and global. So that number will grow. There will be multiple central banks that end up with at least a toehold in Bitcoin. It'll be increasingly used as a settlement currency for large, likely energy-related trade. And it'll just be normal for, our kids and whatnot to have some portion of their savings. Hopefully they have savings in Bitcoin. So that's my highest conviction call, and I've built a node at least around that thesis. And then there's a call option that some of these long tail of Turing complete blockchains, the ones that can execute logic, like Ethereum, like Solana, may be able to take a meaningful amount of market share from a combination of Google, Apple, and the banking system, right? Because these are database environments. You can launch an app, you can sell a service. Right now, the service is mostly trading, but it has the potential to evolve. And you can do it at a lower margin than what Apple and Google takes, 15 to 30% of developer top line, right? So you can look at my position sizes to see my relative conviction in those themes. Some are really still call options, and some I think are being meaningfully de-risked quarter by quarter.
Matthew, this has been phenomenal. Thank you so much for your time. I really enjoyed our conversation. Very informative. Stuart, you wanted to pitch in a little bit? Maybe you could take us home.
Well, what's great is that, part of the financial services business and what you do, Stephen, is to help clients plan for the future. And what we just talked about is definitely going to be part of the future. We don't know exactly how that looks, but digital assets, blockchains, all of the things that Matthew talked about are going to be part of our future. And what I'm so proud of at VanEck is that we are a forward-looking macro firm that keeps very intelligent people like yourself informed of these up and coming trends. And so any ways that we can help you or your clients stay abreast of all of these things, we're more than happy to. And we really appreciate the time.
I do too. Yeah, this has been one of my favorite webinars, and I'm sure it will be very well received. So thank you, gentlemen, for your time. Really appreciate it. As always, if there's any questions, follow up that anyone would like to reach out and have responses to, please do email or call. I'm at Stonewater Financial. My website is www.stonewaterfinancial.com. A lot of information there that can help you navigate through all of these different innovations and the future. So thank you for your time, and have a wonderful rest of your day.